Would you like to learn how to multiply your money without much effort? Can you imagine having more income without working more hours? Well, in this video, I will teach you how to do it and change the course of your financial life. How will I achieve it? I will teach you what compound interest is. First, what is interest? If you request a loan from the bank, you get it in exchange for a price, which is generally expressed as an annual percentage. If it is 5%, at the end of the year, when repaying the loan, if it was $1,000, you would pay about $1,050. If we did this year after year, we would pay $1,050 again. This is what we know as simple interest, but the idea would not be this. Rather, that this price becomes our earnings in exchange for investing our money, and that they are increasingly higher. For this, we will use compound interest and manage to multiply our money, with profits and returns always higher than those of the previous period. Compound interest is the way we calculate the benefits we would obtain if we invested our money and reinvested the earnings year after year, creating a snowball effect that makes the earnings increasingly larger. For example, if we invest an initial capital, this amount generates a certain amount of interest that is reinvested when obtained at the end of the year. The following year, the interest will be generated on your initial capital and on the generated interest, which will increase the interest in general year after year and create a cycle of capital growth. If at the end of the year you withdraw the interest you have obtained, the amount you would obtain at the end would always be the same. This is simple interest. Many say that Albert Einstein claimed that compound interest was the eighth wonder of the world and the most powerful force in the universe. This has not been proven, but in any case, Einstein would have been quite right. Let's look at it with numbers, so you understand it better. Suppose you have $10,000 and you invest it with an annual interest rate of 8%, which is the average growth of the American stock market, over a period of more than 50 years. Therefore, this investment is more than secure in the long term. It is important that, when making an investment, you take into account the effect of inflation, which should be around 3% annually. In the first year of our investment, we would earn $800 and have about $10,800, so everything would be normal, right? Now is when the magic begins. The following year, we would earn $864 in interest, for a total of $11,664. And you must realize that, for the first time, the amount of interest generated has increased. In the third year, we would have a total of $12,600, about $940 more than the first year. $140 more in interest generated than the first year. In the fourth year, the total amount would be $13,604, with $1,000 in interest. In the fifth year, the total amount would be $14,700, with $1,100 in interest. As you can see, the interest you earn keeps increasing. 5 years later, it would be $1,600 more than the previous year, and you would have generated a total of $21,589. 10 years later, you would generate about $3,450 in interest, for a total of $46,610. Finally, after 30 years of making our investment, we would have generated $7,400 in interest, almost our initial invested capital, for a total of a little more than $100,000. So we can say that we made a 1,000% return on our initial investment. How can this be possible? Our 8% would become 33% if we converted it to simple interest. The first year would be the only one in which you would generate 8% of the initial capital. By the 5th year, 10%. By the 10th year, 16%. In the 20th year of your investment, a 33% on your initial capital, and in the 30th year, 75%. Many would say that 30 years is too long, and they are absolutely right. But that's why it's said that when it comes to investments, time is your best ally. Have you ever seen how Warren Buffett built his fortunes throughout his life? If you haven't seen it, I'll show you. If we represent his fortune based on his age, it can be observed that Warren Buffett made 90% of his fortune between the ages of 83 and 92. Going from having $1 million at just 30 years of age to having no less than $132 billion in March of this year, more than 60 years later, he only did what you or I would do: invest his money and let compound interest work its magic. But in the example, we only use an initial capital for our investment. What would happen if we invested every year an amount equal to that capital? Look at the two tables, and let's make a comparison. We would reach the figure of $1,233,000 at 30 years old, and in half the time it would be about $300,000. which compared to our first example would be only 10% of this figure. Now it doesn't seem like so much time. Say well? Now imagine that we do this with a return of 12%. We would reach almost $3 million. Have you noticed that in the last year we generate interest alone of $300,000? The same amount we would have invested in capital? This is indeed magic. And it is the magic that the rich use to become even richer. If you thought that was all, you were wrong. There are more factors that can make this effect even better, like the frequency of compounding, which is simply how often you earn your profits and reinvest them. This and contributing capital more frequently, instead of doing it once a year, whether monthly or quarterly, makes it even more interesting. In summary, we will succeed in using compound interest based on the profitability we can achieve, the time it is applied, the greater capital we can invest, and the capitalization frequency. The better these factors are, the better our results will be. Do you realize the power of compound interest? We can multiply our capital without doing anything more than waiting. The longer the time, the greater the growth coefficient and the profitability of our investment. Mathematically, the formula would be the final capital is equal to the initial capital times 1 plus the interest rate over the number of times interest is applied per period, raised to this number of times by the number of periods elapsed. With this, we know how it works and how to calculate it. But don't worry. In the description, I am leaving you the link to a compound interest calculator with which you will be able to perform the calculations directly, simply by entering the desired data and saving yourself some work. We might think everything is good here, but that's not the case. Compound interest can also work in reverse. If we take out a loan or excessively use a credit card instead of investing or saving our money, the interest will come out of our pocket into that of the bank or lender. If we are in debt and use more credit to pay previous loans, we will have to pay interest on the interest and the earlier debt, creating the opposite effect of what we were looking for and making it increasingly difficult to pay our debts. This time the snowball is rolling towards us, which is why financial education and good financial health are necessary.